SBUX Stock, ticker symbol SBUX. This stock is down almost 7% year to date, underperforming the overall market big time. On the 1st of August, SBUX presented quarter results where they beat on EPS but missed on revenue. For the upcoming earnings, analysts think they will miss. People love SBUX stock because of multiple reasons, one of them being the dividend, and I understand why, with dividend yield at 2.2%. And a great dividend growth track record. So could this be the perfect moment to buy SBUX stock? Well, I'm very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So, what does SBUX do? SBUX is one of the most widely recognized restaurant brands in the world, operating nearly 37,000 stores across more than 80 countries. SBUX operates in three segments: North America, international markets and channel development, such as grocery and ready-to-drink beverages. If we dive in the most recent earnings results, we see that SBUX reported a record revenue of 9.2 billion, up 12% year over year, which is a great number to be honest. Comparable sales are up 10%, which is one of the most important numbers to me. North America is up 7% and international is up 24%. SBUX Rewards memberships reaches 31.4 million, up 15% year over year, also looking really good. And when we check a more detailed version, we see that this 10% comparable sales is primarily driven by a 5% increase in comparable transactions and 4% increase in average ticket. Again, to me this looks pretty decent. If we check the international segment, which was up 24%, we see that China comparable sales increased 46%, which is a great number. SBUX opened 588 new stores, crossing the 37,000 store count. Operating margin was reported at 17.3%. An increase from 15.9% in the prior year. EPS increased 25% year over year. And if we take a look at the segment breakdown, we see that North America is by far the biggest segment. The interesting thing is that operating margin is decreasing a bit here, so that's something to keep your eye on. International segment is growing a double-digit growth numbers in terms of revenue and store count. The operating margin is increased an insane amount, which is very nice. Channel development is the smallest segment, which is decreasing in revenue year over year, but the operating margin is looking really good. And now that we know more about the company, it's time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe to my channel to receive multiple analyses every week. And also join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue by diving into the fundamentals. SBUX is a 107 billion market cap company. PE ratio is at 28, which could indicate that they are overvalued right now. Later in this video I will show you my 3 price targets for SBUX stock, so make sure to watch until the end, because PE ratio is only telling a small part of the full story here. Revenue is at 35 billion and in this graph we see that revenue went up in the long run. To me this looks pretty steady. There is of course a decline in revenue during the lockdown periods. Over a longer period of time margins are going up and down a bit. As of most recently the margins are decreasing again, which is of course due to the China opening up again. EPS is following the same pattern as the margins, nothing really special to be honest. Analysts expect double-digit growth in EPS in the coming years, and to me these numbers look really good. For the revenue it is a pretty similar, but with slightly lower numbers. It is expected to see double-digit growth in the coming years. Return on assets is sitting at 14%, which is a great number. Return on equity looks really low, and the most important number, return on invested capital, is sitting at 67%, which is also a great number. It is higher versus the 5-year average, which is also very nice. Current ratio is at 0.78, which is looking pretty good. It is pretty steady in the range where I am comfortable. Right now Starbucks has 24 billion in debt, and I prefer companies that can pay down at least a big chunk of their total debt with the total cash. Starbucks has 3.6 billion in total cash, so they can't pay down a big chunk of their total debt. This is something that I don't like. So it's very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends and all other things. And here we see that free cash flow is going up and down in the long run, but in general I would say it's going up. Shares outstanding are decreasing, which is a good thing. When shares outstanding are decreasing, it increases your ownership in the company, increases the EPS, lowers the PE ratio and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyways, dividend yield is sitting at 2.2%, which is a decent number. Annual payout is at $2.28 and payout ratio is at 64%. I prefer 50% or lower, so right now they have 37% left in cash to buy back shares, pay down debt, do acquisitions and all other things. The 5-year growth rate is at almost 11%, which is a great number. And they increased the dividends for 12 years in a row, which is very nice. And if you take a look at these numbers, the dividends paid since 2012, you see that Starbucks did increase the dividends at a decent rate. However, most recently they don't do double-digit growth anymore. Payout ratio is a very important metric with dividends. It tells you if the dividends are safe. And here we see that over a longer period of time payout ratio is kinda steady. In this graph we see the expected dividends in 2023, 2024 and 2025. Of course this is an estimation and can be highly impacted by results, but it gives you a rough indication. It's expected to grow at similar growth numbers, which is very nice. And overall these dividends look pretty good to me, but how about the historical returns? I decided to compare StarBUX stocks with the overall market, in this case the S&P 500. On the 5-year chart we see that SBUX beats the S&P 500 big time. In total Starbucks returned 86% including dividends, versus the S&P 500 sitting at 63%. On the 1-year chart it looks pretty different, with the S&P 500 returning 16% including dividends, versus Starbucks returning only 7% including dividends. On the 6-month chart it is a pretty similar story, with the S&P 500 beating Starbucks again with a decent amount. On the 1-month chart it is again the S&P 500 that beats Starbucks. So bottom line, Starbucks beats the S&P 500 in the long run, but most recently it is lagging behind. So could this be the perfect time to buy StarBUX stock? Well, let's check the 3 price tags that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with the revenue growth. For the revenue growth I'm filling in 8, 10 and 12% based on historical performance, their own outlook, but also because of the analysis. For the profit margin I'm filling in 11, 12 and 13. And for the free cash flow margin I'm putting in the same numbers. For the PE ratio and the price of free cash flow I'm putting in 20, 22 and 24. In my opinion Starbucks has a strong moat which justifies a higher number here. My desired annual return is 12.5% since I can get an easy 10% average annual return with owning an ETF. Right now Starbucks stock is at $93. I hit analyze and we see a few green numbers. We have a low price target of $69. We have a mid price target of $93 and we have a high price target of $125. To me the high price target is the most justified here, indicating that this stock is undervalued according to these numbers. My final conclusion on this stock is that I do love the company and I started to like the stock a whole lot more lately. Most fundamentals look pretty good to me, and with China increasing at a high pace I think Starbucks might surprise us all. Valuation doesn't look too bad either, but I'm really looking forward to the next earnings report to have a better understanding of the current situation. Dividends look also really good, the only downside is that dividend growth is slowing down. But with the company picking up pace again, this could easily increase to higher numbers again. For now I'm adding more Starbucks shares if the price keeps dropping. My cost average is around $85, so it would be great if I can match that number again. And remember to always do your own research and never fully trust on what I or other YouTubers say about the stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.